Hello, everyone. Welcome to the Final Bar. My guest today is Fred Meissner from the Fred Report, joining us from Atlanta. If you were waiting for some sort of validation that the world was not ending, perhaps today sated that desire with the S&P up over 2% today. Technology really driving the way back higher. Just like a pullback seemed obvious looking back with how extended the markets have become with technology leading the way up, this bounce certainly seems just as obvious with the severity of the pullback. So what next? Ladies and gentlemen, this is the Final Bar. Hello, everyone. Good afternoon and welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close as we look at the markets through the technical and behavioral lenses, try to make sense of what we're seeing, what we're hearing, and focus on the evolution of trends and try to connect the short term of a day like today with the long-term perspective. It's so easy to get caught up in this transition from bull market phase to bear market phase. And you could feel very quickly the mood shifting on social media with people getting very negative very, very quickly, and understandably so. The pullbacks that we had from last Thursday through yesterday, certainly one of the more severe that we've seen in quite a while. However, I think as we'll see as we look at the big picture, it's sort of normal, right? It's expected. It's part of an overall market trajectory is that you're going to have these impulse move and corrective moves. Perhaps what we saw the last couple of days was a digestion as opposed to a signal of much further downside to come. We're going to see what we can tease out together, and I'm excited to hear what Fred Meissner has to say on that question in particular. Coming up on the show, Fred's joining us today. Next week, we have David Keller joining us from Market Scholars on the 15th, and on the 16th, Pat Seresna joining us on the show. I did want to mention again on September 22nd, we have our next big event called Introducing StockCharts ACP. I just had an interview this morning with Mish and Keith Schneider down in Santa Fe, New Mexico. Mish and Keith are the founders of Market Gauge, and they are providers of one of the new plugins as part of our ACP platform. We've had a really good time having conversations with people like John Murphy, Martin Pring, Mish and Keith, Arthur Hill, many, many more, getting information about their process, how they've been involved in ACP, and what this new platform means for you using our StockCharts platform. So it's going to be a lot of fun. Chip and Grayson and I sharing you the latest from StockCharts. That's coming up on September 22nd, and join us then. Let's get to our market recap. As I mentioned, the last couple of days, look at a daily chart of the S&P here. The last couple of days, certainly feeling the pain, coming off of all-time highs just below 3,600, reaching that seemingly unrealistic objective that I remember talking with people about back here at S&P 2,600, 2,700. When you threw out objectives like 3,600, that seemed like the most ridiculous statement ever. But we did it almost to the tick. We got up to 3,600. Since then, we pulled back very quickly, right? And yesterday we notably closed below 3,350, which, by my short-term read, that's the most recent swing low. That's where we spent about a 2-week period here in early to mid-August before breaking to new all-time highs on the S&P 500. So understandably, the first leg down kind of gets us right back to that level. We closed lower yesterday. We did not follow through today. We actually went back higher. So right now is I would argue, a critical sort of point where, as a short-term investor, you see whether or not this is the pause before the next leg down, and we continue to go down to that 3,200, 3,250 level, which I don't want to say I think we're absolutely going to go, but I think the evidence supports a bit of a further downside down to that 3,200 level, that range, based on all the breadth readings that I'm looking at. Or this could be the pullback. We never really establish a new swing low, and we return to new highs. So we start to appreciate from here and get back into those levels. All of a sudden, this looks like just a garden variety pullback within a longer term uptrend. It's amazing how much negativity has come out so quickly, though, and I think that tells you how we've all been sort of expecting and waiting for this sort of pullback. I don't know if 3 down days satisfies the extended environment that we've seen with stocks up until now. So I feel like we need more of a pullback in terms of time and price to really feel like there's potential for further upside. I think if you're long-term optimistic on stocks, I think you want to look for more backing and filling, which gives the market more of a chance to sort of build momentum for a new wave of buyers to push price, or new set of buying power to emerge to push the price to further highs. So right now, for me, I think it's all about 33.50, the 50-day moving average just below that. And if those are able to hold, which means we're, it's a pullback within a longer term uptrend, we start to get down to 3,200. And if and when we would break down through there, I think the characteristics of this market change very quickly. I think a lot of people expecting support and recognizing it's not happening. That recognition is what causes that big third wave as things can get ugly very, very quickly. But first things first, 33.50 is on the table. Let's look at what else has happened. We sold off a little bit going into the close of the S&P closing just around 3,400, but that came in the last 30 minutes or so. Overall is a pretty decent update with the S&P up just over 2%. Mid caps and small caps noticeably were not along as much for the ride, up 1% for small caps and 1.33% for mid caps. The Nasdaq 100 driving up almost 3%, with technology the number one sector up 3.25%. If you look at other markets, other asset classes very quickly, bonds essentially chipped away, going lower through the course of the day, only finished down about 0.25%. The dollar also weakening as well. That's coming off of a nice uptick yesterday. On the commodity side, gold and silver actually behaved really well. So you have one of those conditions where stocks and gold actually move up together. And again, I always cringe when I see people oversimplify or hear them talk about, well, stocks do this, which means gold should do that. If you ever catch yourself saying that, try not to, because for every example of where stocks and gold move together, I can show you plenty of examples where they don't, and vice versa. I think we're oversimplifying when you think of the two of them as moving inverse to one another, or having a tried and true relationship just based on the two. It's actually a relatively fluid relationship, and depending obviously on a lot of different factors. In terms of sector movements and what we saw today, technology leading the way higher, followed by materials. It's interesting, as I was looking at charts for the 3 and 3, one of them is Dow from the materials sector. It's actually just a beautiful setup, kind of long and strong up and to the right. And it's interesting that given the pullback that we've seen, there are a number of stocks that are actually just in continued uptrends. And I highlighted 3 of them today, but there are many more that I could have put into that bucket. On the downside, you have energy leading the way lower. And again, based on just the relative trends in energy, I think you'd be hard pressed to justify from a momentum perspective to focus on energy as on the long side, given the relative underperformance, given the breakdown of support that we continue to see through today. Financials, second from the bottom, followed by real estate. So some consistent players there at the bottom of there. And if you're looking for financials to emerge in a position of power, it did not get the follow through on it today. It's interesting. One of the, I won't say controversial, one of the things that I mentioned and put out on social media today that got a lot of discussion going was talking about technology potentially breaking down and utilities breaking out. People got very defensive of that as an illustration. And again, I certainly wasn't suggesting you design a trading system going long utes and short technology based on the last couple of days, but I think it's worth noting, and I think my point was the relative strength on utilities turning higher, the relative strength on technology turning lower for the first time in quite a long time, if you look at the last 4 to 6 months. So again, it's still early days. It's still a couple days into a pullback off of all-time highs. So I think it's a little premature to be declaring the end of anything. But again, this is the time when you focus on key points, key lines in the sand, key opportunities. In terms of other themes to tease out, automobiles, the number one group today. So Tesla, after having quite a bit of pain in the last couple days, bouncing back up in a pretty decent way, up over 10% today. Ford and GM, we talked about yesterday, just looking at charts that were setting up overall sort of constructively. So the group as a whole up 8%. But other familiar groups up here like computer hardware, software, semiconductors, all behaving well. So again, this is sort of a reversion back to the leadership that got us to this point, with some of those groups doing a little bit better after a couple of days of pain. Interesting to see mining and gold mining groups up here in the top 10 as well for the first time in a while. Also home improvement retail coming off of some short-term weakness as well. On the downside, groups that did not do so well or had a tougher go of things today: airlines at the top of the list, clothing and accessories up here, apparel, retailers, hotels. These are some groups, feeling a little bit of weakness in here. And again, nothing down big today. It was certainly on average a more positive day for stocks, but worth noting some of the groups that did not participate as much. We're going to finish off here before we take a quick break. I just wanted to highlight on the wrong slide. I want to highlight on the breadth indicators. Had a bit of a read here. So when we're looking at breadth, we've talked about a lot of different breadth indications recently, and the one that I wanted to focus on was just advancers, decliners. One of our questions coming up in a bit is going to deal with this, so I just wanted to hit on where we're at. So today, a pretty good up day with 75% of New York Stock Exchange listings higher on the day. So 3-to-1 ratio up versus down. That is certainly a change from the last couple days. So you never really had a big 90% down day. That's what you saw here back in the second week in June, when it felt like a big sell-off, big distribution coming off the highs. Really didn't get that. So even though the market sold off pretty well, even though plenty of individual names sold off pretty well, not even 80% of the New York Stock Exchange was down on any of those days. And, we often talk about 90% up days, 90% down days, really recognizing a capitulation of sorts, that everything sort of on one side or the other. We really haven't had that yet. You haven't had that broad move on one side or the other. Again, in the last couple of days, even with the pullback that we've seen, hasn't been the extreme negativity that have been characteristics of some previous tops. For what it's worth, that's something that caught my eye. We're going to take a quick commercial break. Back with my guest, Fred Meissner. We'll see you in a minute. Hello, everyone. Welcome back to the show, The Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we love to hear from you. Feedback on the show, feedback on our guests and our conversations, but most importantly, questions that you're running into using StockCharts.com, using technical analysis, particular tickers, themes, groups, whatever it is that you're looking at, that you're running into trouble, let us know, and we'd be happy to address some of your questions on the air. As a reminder, 2 ways to get questions to us. One is via email. The Final Bar at StockCharts.com is the way to get a hold of us, or on Twitter, tag us in anything, just at Final Bar SCTV. Again, we'll gather all of those. We're going to do a mailbag segment a little later in today's show. We'd love to answer one of your questions in a future broadcast. I want to welcome on my friend Fred Meissner to the show. I've known Fred for a number of years through the Market Technicians Association, now the CMT Association. We really enjoyed Fred sitting down with you in Atlanta. It feels like a long time ago. It was earlier this year, but it feels like years ago with how much has changed since we sat down. But it is a pleasure to have you on the show, my friend.
It's good to be on. And Dave, I have not been back to Buckhead or anywhere near that hotel since our interview. So yeah, years.
that was it, huh?
Yep.
So, looking at the market, we've talked in the show so far, just, obviously a big distribution over the last couple of days. I think a lot of people are debating whether this is the beginning of something much deeper, or this is the, sort of pullback within a healthy pullback within an uptrend that is very much needed. We're starting with your chart using the put-call ratio. Give us a sense of what this is telling you.
Sure. As people look at the chart, realize that we are seeing multi-year lows in put-call, which means that calls are being bought at an alarming rate, and that tells me that everybody has been on one side of this market and ebullient or irrational exuberance. And the sort of correction we've had with the dramatic flush is what happens when you get sentiment at a bullish extreme. This has happened before. It looks absolutely normal to us. So we're not surprised. We wrote about it it's sort of funny, Dave. We actually wrote, we're going to see this in a couple of weeks, and we saw it 3 days after we wrote about it. So this is normal. Yeah.
Well, and it's interesting. I mean, it's a perfect example of just the time compression. Things certainly seem to be happening very quickly relative to what they might have before. But again, looking at the chart, it's interesting how much what we've seen recently with an extremely low put call ratio and then the pullback, it actually looks very similar to the beginning of 2018 when you had the rally in January and then the quick pullback, with an extreme low level as well.
Yeah, usually what happens is there's an event. Back in 2018, it was President Trump suddenly throwing out the China card and putting on tariffs and stuff, and that surprise causes an extreme change in sentiment. And that's the sort of thing we've seen here. One thing which you didn't mention and which is not on the chart, Dave, is I looked at the put-call ratio last night. Last night was still fairly heavy towards calls at 0.85. So that does speak a little bit to the point you made earlier in the show of not seeing enough panic or freaking out before this thing bottoms. I wrote in a note to my clients this morning that we were expecting a bounce, but that we could see some lower prices over the next few days as calls start being sold and puts start being bought.
So having said that, Fred, I'm bringing up a chart of the S&P 500 here, the spiders. We're looking at the 5 and 20-day moving averages at the bottom, the stochastics. So based on what you just said, what should we be looking for here? Are there key levels you'd be identifying or a trigger that would tell you whether or not this is the beginning of something deeper or a rally to further highs?
Well, my trigger has been that daily stochastic doing what I call a buy recycle, which is going below and then above 20. That's when we're going to start putting money back into the market. And I believe, I did not look, but I believe we've had that today. So clients can now start adding some of the cash that we've raised over the last few weeks back in, not all in one day. And again, Dave, remember my client is large brokerage firm teams with lots of money. It's not individual traders. Right. So we're going to start putting money back in, but we are looking at some different areas to put the money back into, not technology.
Well, you bring up technology. We'll switch to the Qs here very quickly. So obviously technology has been the leadership. That's been driving things. Then the last couple of days certainly have been driving, down the downside. They sort of led on the way up and quickly led on the way down. Today, a bit of a rebound. What do you see looking at the Qs versus the S&P?
Well, I like the way the S&P looks a little bit better, and I'm assuming the high relative strength technology stocks, which are the biggest ones in both indexes, are going to continue to do well, perhaps not as well. Sort of go sideways, and we'll see some other groups and sectors come to the fore as money sort of broadens out and the economy improves.
Now, we only have about 30 seconds left, but I did want to bring up transportation because before we went live, we were talking about the transportation ETF, IYT. This is an ETF, I mean, that's actually holding up pretty well. While other things are really rupturing a bit, the transports have actually held up pretty nicely. What's your read on this group in particular?
That is the most economically sensitive index, Dave. That gets above 203, 204. That says the economy is going to be good and we're off to the races. Other sectors we're looking at, you highlighted one, XLB, and we're also looking at XLI, industrials. We think there's going to be infrastructure in the next year, and that's when those stocks are going to start to do well. But the high relative strength names may surprise everybody and do nothing for a while, just build bases. That's
right. Fred, it's such a great take. Thanks for walking us through your perspective and showing us some of the charts top of mind for you. Hope you stay safe, and we'd love to have you back on again soon, all right?
Certainly, absolutely.
That's Fred Meissner joining us from the Fred Report in Atlanta. It's such a great opportunity to sit down with him again. As we alluded to, we had him on the Behind the Charts show earlier this year, sat down with him in Atlanta. That ended up being the last trip that Gretchen, our producer, and I took before the lockdown due to the coronavirus. So sort of a near and dear to our hearts being able to go to Atlanta. That was our last trip, and then the Money Show down in Florida. So great to hear from Fred, and I think his take certainly feels a little more constructive than some of the other conversations I've been having, thinking more of a potential for further downside. Our next segment is called the Final Bar Mailbag. This is where we answer some of your questions that have come through in recent days. Let's get right to it. Interesting, we were just talking with Fred about transports. The first question, when you get a chance, can you reflect on the change in airlines? What should we be looking at here? Let's bring that up, and hold on, I'm going to bring up the Jets ETF just as a start. And again, a lot of times some people have asked me about ETFs that I'm using. Why would you use an ETF like this? And I would tell you what I learned many, many years ago. This is when ETFs were just sort of becoming more and more popular. It was early 2000s when I was getting started in the industry. And, I remember looking at ETFs, even though a lot of them were not super liquid and there weren't a ton of them relative to what they're become. The value of having transparent price data on a tradable security and all these different things had a lot of value. So when I'm showing you something like Jets, I certainly don't mean anything as in this is a particular ETF you should be considering for your portfolio. I would certainly, anything I'm showing in particular with an ETF, I would do your due diligence in terms of expenses and spreads and all of those things that I'm not able to cover in this sort of show. My point of bringing up ETFs more than anything is to look at the data. I found looking at ETFs as a consistent sort of price data that we can all look at together. We can make sense of things. So I'm not paying as much attention to the liquidity aspects, which is a very important part, obviously, of looking at ETFs, along with expenses and structural challenges and so forth. So all of that being said, let's look at airlines. We'll start using the Jets ETF, then we'll look at a couple of them maybe individually. So, airlines, I think overall have been struggling, and I think on a relative basis more than anything. They peaked out in June just like everything else did. And if you looked mid-May to mid-June, it was actually an impressive run because they had held down. So they actually had a double bottom, this Jets ETF. Set the bottom in May, a little bit before the market bottom in March 23rd, then another retested those lows in May. So this is while other stocks were sort of having their V bottom and appreciating into the June high. Airlines actually remained relatively muted. Then they had a big run of outperformance going into the June market peak. Since then, it's been sort of a rounding, bottoming pattern as it's come back and sort of played around the 50-day moving average. So overall, it's hard for me to get as excited about this group relative to others that I think have held up a lot better and have shown the ability to outperform over consistent periods of time. Having said that, I can't deny the fact that since the August low, for sure, we've now seen a new swing high. We've now seen a higher low. At this point, we're sort of testing a new swing high once again. So I like the pattern that I'm seeing in the short term. And as long as we hold the most recent swing low, by definition, the short-term trend is positive. I don't disagree with the idea that you can expect that trend may continue. What concerns me, though, is the looming large up here, the resistance of the 200-day moving average, the June high, which we've not gotten close to just yet. So that's a lot of resistance to overcome to feel like this is going to have a lot of upside. And again, we're not getting into the fundamental picture here, but just the technical picture. So overall, I don't mind the short-term uptrend. However, I'd certainly want to see it hold on any sort of pullback. Now, having said that, within airlines, there's actually a lot of different individual names you can look at. And the best way to get a hold of those, to be honest with you, go here to Charts and Tools, go to the industry summary page, go down to industrials, which we will do very quickly. And then you can look at airlines and you can look at the entire group. I think if you sort these, finding some of these names, maybe like Allegiant and others that are higher ranked names relative to their peers, if I had to pick one, Allegiant probably would be the one. And again, it's still not able yet to get above the June high. That would be the key follow through that you would want to see right now. However, I can't deny it's broken above the 200-day, broken above its recent swing high. It's making higher lows. Overall, I don't mind that trend. It's close to making a new 4 or 5 month relative high. So overall, it's not a bad chart, to be honest with you, especially relative to other airlines. If you're going to pick one, I'd be leaning into the ones that have better price characteristics. That's my take on airlines. Question number 2, this is from yesterday's show where I was looking at the RRG charts, part of our normal weekly process. That might have been yesterday, I think, looking at sectors. Why look at the RRG plot as weekly instead of daily, particularly because the last 3 days have shown such a dramatic change? Looking weekly seems like it would filter out the noise, but in this case, it's filtering out the signal. It seems looking at daily with a longer tail, meaning a longer time period, would give a better view of the market change. That's such a really thoughtful and well phrased question. I get where you're getting at. And here's my answer. I look at one RRG consistently, and it's the weekly RRG. By design, when you're looking at daily charts versus weekly charts, for me, the weekly charts are about the longer term trends. And that means you're going to miss out on some of the signal on the shorter term time frame, meaning the daily chart, and that's fine for me because I just want to focus on the longer term trends and how they're evolving. What that means is at an inflection point, when things are rolling over or when things are bottoming out, it will take a little bit of time for the RRG, the weekly RRG, to recognize the inflection point that you've seen. Your point is, why wouldn't you just look at the daily chart and look at a longer time frame? That's totally fair. And to be honest with you, in a 30-minute show, I show you bits of my process. I can't get to everything just because it's a 30-minute show. It's not nearly enough to get to everything. But if I really wanted to have a complete picture of sector rotation, I would look at both. I would look at the weekly chart to get the longer term trends. I would get the daily chart to see how some of those trends are changing. And if you listen to Julius DeKempeter's show or any of his webcasts, you'll see he advocates sort of the same thing using this methodology he's designed. When you look at the daily RRG, you can see this huge rotation away from technology, away from communication services, into materials, into financials, into utilities, all these things that are sort of rotating northeast. My challenge with looking at it on this time frame is all of a sudden you're getting a lot more noise. So you're getting more signal, you're also getting more noise. So I have the same reaction, to be honest with you, when I look at the market trend model. I had some people mentioning when I showed this on Friday and said, listen, if this is all you're looking at, you're missing out on the fact that there's a lot of signal. And I don't mean to ever suggest I would look at this and not look at something like a daily chart. I think a well-informed investor is looking at multiple timeframes and looking at the relationship. So for me, the weekly chart, looking at the long-term trends, is part of it. The daily chart, this is my process here. Weekly chart is number one, daily chart is number two, to see how the short-term movements might relate to that long-term trend. But you have to start from the perspective of the longer term trend. So that is my answer. You're right. And maybe, as a better illustration of the shift that we've seen in the last couple of days, the daily RRG is absolutely right. And I would certainly encourage you to use both thoughtfully and intentionally. And I think you're going to be in good shape. Final question. I mentioned the bullish percent index yesterday, talking about a bear alert warning where the bullish percent comes back below 70%. And the question was, is that any relationship to advancers, decliners? Boy, I don't know if I can bring up this chart quickly enough to make my point. I actually have it up right here. So this is the bullish percent chart that we looked at. And again, this is the percent of stocks in the S&P that are in a buy signal on the point and figure chart had been over 70% and rotated back below 70. That's called a bear alert. And if you're not familiar with what I just described, look at the chart school articles on bullish percent. It'll explain the different signals and what this actually represents. Your question was, how does that relate to advancers, decliners? And to be honest with you, similar, right? They're looking at similar things in that they're both an equal weighted breadth measure, but they're looking at different data. Advancers, decliners looking at every day what closes higher or lower than yesterday's close. And then the bullish percent is actually looking at point and figure charts on all those 500 names and saying which ones are on buy signals, which ones are on sell signals. As a result, you'll have similarities between the two, but the breadth data is coming from different places, and that's why the signals can be a little different. We need to wrap the show, go right to the 3 and 3 charts, 3 minutes. Here we go. Chart number one, and actually all three of these, there's a theme here, and these are three stocks that are holding up just fine given a downtrend. I'm always interested when the market goes through a transition, which charts do you see that don't indicate the transition, that indicate that things are sort of fine? And if you didn't know that the market had been so painful for a couple of days, you wouldn't necessarily know it from looking at these charts. So these are the types of names that I think make sense here. If you're looking for opportunities for further upside. Chart number one is Nike. This is within consumer discretionary. It's a name we've talked about before, but had broken to new highs in mid-August. That's after setting a double top in June. Nice breakout pattern, so a bit of a cup and handle like breakout, pulled back to 110, but now rotating back higher. 117.50 is the resistance from the previous peak, but overall a new relative strength high for the last 12 months and setting up beautifully. The second chart's within materials, Dow Holdings, ticker DOW. And again, if you look at the pattern, it's again set the peak in June like many did, back below its 200-day, back above it, hit that resistance and broke above it, retested it, and now following through to the upside. So I like these charts that are just having these slow and steady gains. Became overbought about a week ago, but overall rotating just fine to the upside. And then finally within industrials, Caterpillar CAT making new 52-week highs today, up almost 3%, and the relative strength doing well. So as a reminder, even though markets are challenged, there are stocks doing just fine. Folks, that's our show. I want to thank Fred Meissner from the Fred Report for joining us today. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.